If you want to start or scale your property development business to 8 figures and beyond, then you're in the right place. This is the Property Experts Podcast with Ben Richards and Jack Jiggins, two serial entrepreneurs bringing weekly insights from our award-winning businesses. In these podcasts, you'll learn how we found, funded and delivered over £80 million worth of property in the last 6 years, with templates you can use, deal analysis and deep dive discussions that will help you build your businesses successfully. We hope you'll enjoy.
Hello everyone, happy Friday. And hopefully there's some people tuning in live. Welcome back to, again, another episode of Property Experts Podcast, brought to you every Friday live by myself and Ben. We co-founded multiple businesses. And hopefully if you're listening, you also might be looking to get into business or also running your own business or property or potentially investing in property. Our goal is to deliver 1,000 homes, which is £1 billion worth of property in the UK. We're just over 10% of the way there. And I'll be sharing something with you shortly, which will show and hold testament to our sort of 3 core values, which is ambitious, transparent, and creative, which I think is actually on the next slide. So we grow our businesses by partnering with investors. And today, to do something slightly different, I've actually got a testimonial from one of our investors that we've worked with and have completed a project with. So bear with me because he's quite good with long words and I'm not good with reading. So this is one of our actual completed investors that wrote this, which is amazing. So he goes on to say, as investors seeking prospective deals, we took a lot of time finding the right fit for not only our funds, but also on the investment, but relationship with individuals that demonstrated specific qualities. We encountered many individuals and deals that appeared investable, but once questioned on specifics across the, here we go, multitude of dimensions, didn't stack and raised red flags. Jack and Ben, who are us, the hosts today, of XP Property, were ultimately head and shoulders above the competition for their transparency, quality, and timeliness of communications, their attention to detail and quality of their deal pipeline. And then I actually go on to write a 2-page testimonial of every section, so including funding and acquisitions, planning and design, and exit. So if any investors, prospective investors would like to see that or book in a call with us, please do. We've already got some comments coming in. So let's jump straight into the agenda. And if you are tuning in live, make sure you ask questions because it's free and we will answer them to the best of our abilities. Can we do a next slide, Ben?
Sorry. Yeah.
Cool. So podcast listeners.
I was genuinely actually just reading a message from that investor on WhatsApp.
There you go. Yeah. So the so the date today is the 17th of October for our podcast listeners. And we've got a plethora of topics that we're going through today. I'm going to be talking about specific deals, also the budget and progress on our project. So we're going to kick off things with the budget. We've got a looming budget. Everyone's talking. We were at an networking event today, and everyone's talking about the budget and what it's going to do, where it's going to go. And we're going to be talking about specifically business rates, rebanding, and how that can impact the commercial markets. So if you're investing or buying commercial buildings, how there might be opportunity, but also potentially some threats. We're going to be talking about Maple Rise Investor Day. If you're an investor and you'd like to see probably our sexiest scheme, make sure you stay tuned for that section. We're going to be talking about block valuations. So these are blocks of flats that you're getting valued or refinancing. It's not the same as a standard valuation. So there's certain rules that apply, and we've actually got a little hack of how you can get around that. But we actually wasted money on a valuation prior to that anyhow. We're going to be talking about St Andrew's Court, which is our PD scheme in Tame, and the phase 2 part of that and how it is flying. We're going to be going into what is selling in the market from a commercial space. So I'm talking about sizes and types that are selling in the market at the moment. Planning approval update on the bank, which I'm excited to see and hear. And then we'll be going into why we're bringing digital marketing in-house. If anyone's got marketing or digital marketing, this is a really hot topic to listen to. I'm going to be sharing from an acquisitions perspective, almost semi in line with the budget too, how you should be offering in today's market. It's a really, Ben, your screen.
Yeah, just realised.
It's a really difficult market to be operating in, and how you should be sort of focusing on your bidding process in that place. We'll be then filing on the old surgery and letting you know how we're letting it out. That's a doctor's surgery that we converted into cluster flats. We'll talk through cluster flats later on if you haven't heard of them before, but they're basically cluster HMOs. And then, of course, we've got Q&As. We've already got some questions that have come in over the last week since our last live, but I can see some live people. Even Suresh has said hello. Make sure you do get your questions in, either on the topic as we're talking through them, or a more generalized question on anything, literally anything, and we will come to it at the end. Hello,
Nice.
Ben.
Hello. Before we jump into topic number one, we have the Property Investors Award on the 15th of November. I think we still have some spots left, maybe one spot left on our table. Yeah. So if you want to get involved and be surrounded and have an evening with a table full of award-winning property developers, then drop us a DM. Let us know if you want to come. I think tickets are maybe, is it 250, 300 quid, something like that?
We have a 35% discount because we're such big name on campus. But yeah, I think it's just under 300 quid.
Nice. Yeah. So Jack and I are judges this year, and we've seen some awesome submissions, and we ran through those a couple of weeks ago in the Shawbrook Bank office in London with lots of other previous winners and now judges. And Jack will be co-hosting the event. So yeah, big night for Jack. And we can all sit and applaud and watch as things progress from our own table. So if you're interested in joining us on that, then yeah, reach out. Cool. So the budget. Why business rates rebanding could impact commercial investments. This is one of your topics, and I'm interested to hear your thoughts, and I'll hopefully be able to chime in at some point.
Yeah. So essentially, Ben, it's dropped off your screen again. I'm not
yeah,
sure
no, it's fine. Yeah, I'm just
essentially the Labour government are looking to change business rates. That's kind of like the broad topic that we're discussing today, and it's, I mean, even since COVID, or even I even want to say even before COVID, when sort of everyone was saying that the high street is dying, I completely agree. It's really, really tough to run a business. Only this week, 2 pub restaurants have declared that they're going to shut in Henley-on-Thames, which is one of the most affluent places in the UK. And if they're struggling, and there's people that can afford to spend money in those locations, you can just imagine the sort of blood on the streets really across the whole of the UK. And there's certain things that benefit small businesses and commercial assets at this stage, and there's certain things that don't. And the Labour government have really started to look into what this looks like, because obviously they've got a big hole that they need to fill because they've been spending too much, and they need to obviously bring capital in, and business rates is actually a really good way for them to do that, because it's basically, before a business has made a profit, they're typically taking anywhere between 40 and 50p in the pound of your rental charge to add to the tenant's bill. So for an example, if you've got a barber shop that's a rateable value of £20,000, their business rates bill might be anywhere between sort of £9,000 and £14,000 per year, as well as the rent that they then have to pay to the landlord. So it's a really good revenue for the government. So they don't necessarily want to forego that, but they also want to support businesses from the bottom up. And now, what we're always advocates for is supporting the small and medium businesses, because you've got larger businesses, Henley-on-Thames as an example. There's independent coffee shops who are having to pay the same business rates as Starbucks, but they're not paying 1% HMRC corporation tax because of an offshore structure. They're spinning the wheels as an independent, locally founded, family-run business, and they're paying the same rates as someone that doesn't pay as much tax. So at the end of the year, when you look at their costs and Starbucks's costs, Starbucks have got a huge saving. If they're paying 1% of their net profit turnover as a corporation tax, they're technically saving 24% of their net profit margin against a localized business. So I'm all for supporting local. I personally think that any independent small business should have so much relief that they actually flourish and bring in employment, and maybe open up a second place, because it's very rare that you get a small company being a chain very quickly. and to make it a level playing field to support local business. But essentially that we're expecting some changes, and I can sort of talk you through some changes that you may expect. There is actually a forward, which is like forward, but with an E in the middle, that the government has brought out, which is basically kind of like a white paper of all the areas that they're acknowledging that might need to be changed and that they are willing to change. And the fundamentals are they're basically looking to remove some tax barriers to incentivize investment and growth. They're looking to support the high street through lowering rates for smaller properties. And they're looking to also make the system better by basically trying to either there's some sort of integration with VOA and HMRC. And the reason that business rates is a little bit clunky is because the valuation office, which is the VOA, go and value the site. The councils are the people that are responsible for the billing and then bill that particular site. But a lot of places that we look at, even the VOA figures are completely shot. They're not even correct. And it's going to add a further layer of difficulty because a lot of VOA measurements and ratings are done on certain uses and certain types, but they're looking to take it a layer further and split things up laterally and vertically rather than taking blanket valuation. So for an example, if you're on the high street in prime position and you've got a really long stretch, almost like it's a calculation. If anyone knows, it's a calculation for retail space. It basically means if you've got 1,000 square foot building that's only 3 foot wide, or 1,000 square foot building that's 20 foot wide, on a high street, the 20 foot wide one has more high street presence. Therefore, it's got more value to it. So the way they value it is the depth of the site rather than the size of the site. And they're looking to potentially integrate some sort of banding, not only vertically and laterally across the site, but also depth of high street and things like that, so that a back store isn't paying the same rates as somewhere on prime because it doesn't support that particular value. But I mean, for me, if a business does well, they hire more, they expand, they do other things, they diversify, they pay more tax. So I actually believe that they should just be more relieving at the front end and essentially promote people to be paying more tax on profits, really. Obviously, it's a little bit difficult because there's a leaky bucket. Let's say the taxes are leaks. There's certain ways people can plug over those leaks by off charging or offshoring or putting into different entities. So it's a complicated task. Some other things that have been discussed. So the sort of slicing up and looking at the different bands model is actually called their slab and slice reform, which is quite a cool terminology. So essentially, at the moment they take a slab, whereas they're thinking about slicing it up into more intricate valuation methods, which is all well and good, but they've got to have the right surveyors on board at the VOA to make sure it's fair, because when you do a valuation on a site, that's going to implement a business for 10 trading years. So it's got to be accurate. We found that a lot of government-led analysis or work is inaccurate. And if that then impacts your cost over a 10-year period, that's certainly not ideal and gets amplified as a problem. This was one that I was mainly worried about, which was small business rates relief. So for those of you that are not aware, we have actually talked about small business rates relief before. If your rateable value is below £12,000, you get 100% of small business rates relief. So essentially, you don't pay business rates. You apply for small business rates relief. You prove that your rateable value is less than £12,000, and you get full relief, which is amazing. I love that end of the market, promoting small businesses to break into new areas without rates. It's then a sliding scale from £12,000 to £15,000. So if you're at whatever the difference is between, let's pick a midpoint. So if you're at what is halfway through that, so it's 3,000. So if you're at 1,450, you'll be paying 50% relief and 50% charge against small business rates relief, which I think is pretty ridiculous. It's just there's not much delta between that two. Yeah. And equally, if you're in central London or in central Henley, your rateable values are going to be different for the same style of business. So I do think that has to be improved. What I was concerned about is they would do no business rates relief, but actually stagger it generally. So for every 1,000, you get you get less of a relief, for an example. So let's maybe say you pay estimated rental value of £50,000, you get 1% relief, and everything down 49.2, 48.3. But they are actually looking to maintain that and actually promote bringing in something that's more favourable for small business rates, which is really good. There's improvement relief that they're reviewing, which is basically a 12-month relief for properties being upgraded. And a lot of people say that's too short. I mean, I think it's probably landlords or tenants trying to blag a bit longer. I mean, it shouldn't take over 12 months to do a fit out. Maybe external maintenance or repairs could be longer. There's actually a building in Abingdon, and I've been watching this gable wall move and move and move every year. And it got to a point so bad that they had to prop it up. Now they've actually removed half of this building, and it's completely sort of being held up by everything. That's probably a 2-year project, realistically, end to end, to tenant leaving and tenant moving back in. So that's a good example of where it could be extended, but I think that's probably a little bit much to ask. But the government said they will revisit once they've got more data. Empty property reliefs, similar. I think the Labour government will actually go the other way. I heard a stat the other day. It's something crazy, like there's more vacant commercial property in London than there is occupied property in London. So I think the Labour government will go against empty property relief and actually probably start surcharging that to encourage landlords to do it. There were talks about this fair game bidding, where the government could basically let it out for you at the same rateable value that is market rent. But apparently the government are going to keep reviewing that. Obviously, if it's a listed property, you actually get full relief because there's expectations.
Isn't that like they've got to find the people that want to let the space? Like it's not empty just because of these reasons.
Yeah,
it's
so
empty because people can't afford to do it. So.
Yeah. So what they're trying to we talked about in the podcast a little while ago. What they're trying to introduce is basically like an auction. So if you've had a property that's empty for so long, you have to go to like a formal auction process to market, and you basically have to accept the highest bid, which is crazy. It's basically, you as a landlord should choose who goes in where. Because for an example, when I'm going to show you a commercial property that we sold. In the leases of selling these properties, we put in stipulations in the contract that they couldn't have hot food in the property, because then we wouldn't hot food that are takeaways in the property, because then we wouldn't be able to get a remortgage on our flats above. But if you've got every man and their dog bidding on it, you don't know what's going in there. So it could devalue the rest of the asset if it's a mixed use asset, or even if it's just a commercial asset, could reduce the value of it. So that's interesting, but they're going to keep reviewing that. We've talked about the valuation and revaluation issues that have been in case, and they're not looking to increase the frequency of the valuation, but looking to basically ensure that they're slightly more accurate. And some sectors they're actually looking at doing a receipts and expenditure process, which is crazy. But I think this is actually more for airports to sort of judge what's going in and out and how they can potentially control that. And then I've talked about the administrative reform, where the valuation office will merge with HMRC to streamline operations and improve accountability. So quite a lot of potential change. I mean, there's a lot to go through there. I mean, it just makes you think who is in charge of this, and hopefully they go through it fair enough and with a fine-tooth comb. But a bit of business rates is a huge revenue in the UK, so it needs to be dealt with correctly to not, tarnish. I was getting my hair cut by my barber the other day, and we were talking about this, and he sort of said, like, if there is a significant change for the worse for him, i.e., if rates go up for a business that are between 10 and 20,000, he may consider shutting his business. And then who replaces him? No one. It's a very difficult market space. And I am talking more about retail. I find that industrial and sort of outskirt buildings don't probably struggle as much because it's more purposeful. But yeah, a lot to look at and read. But I can actually send the forward into the comment section so you can have a look on YouTube. But yeah, there's a expected change, and it'll be interesting to see how we get on.
Did you mention about kind of, in particular, one of our office projects where we've got 7 office suites? We aren't increasing our rent because we know that it takes those tenants into the bracket where they don't get small business rates relief. So we are not doing them a favor. We sort of are doing them a favor as such. Like,
Well,
the rent should be higher because it warrants that rent, but we don't want to lose them as tenants because
it's not really that we're doing them a favor. It's the fact that if we did up it, it doesn't become 5%, 10% more expensive. It comes 60% more expensive because it then triggers. So we can't let it. We wouldn't. If we had that building at that rate, we just wouldn't. We wouldn't let it for that value. And it's kind of driving a really hot sub 12k market space, which it is. If you had a under 12k rateable value building, it would let pretty quickly, and you will have a bit of turnover because it's mum and pop businesses. That's the nature of it. But yeah, exactly. Like it's driving this big. That's the issue. It's driving this massive step that you then go, well, what the fuck? I can't operate like this. It's not. It's not that good.
I guarantee there are loads of small businesses out there as well that are in, like, our office spaces were brand new 3-4 years ago. They're top notch. We've just refurbished and repainted the kind of entranceway and the toilets, and it looks really great. But I guarantee there are a lot of landlords out there that have offices like this or retail spaces or anything where business rates are impacted, that they're not charging what they should from a rental perspective because they can't, for the reasons that we've just discussed. But it also means that because they're not charging enough rent, they also don't have the surplus funds to do maintenance works and some of the things that they really want to do, but they just don't have the cash to do. And I guarantee there'll be a lot of substandard spaces out there that the landlord doesn't have the surplus funds to do the works that are really needed to keep and upkeep that space because of these reasons. And I think it does need to be completely re-looked at, rebanded. That delta, like you were talking about, between it's 12 grand to 15 grand. It's 3 grand of delta between paying nothing and paying everything. It just seems absolutely ludicrous.
So my reliable source, ChatGPT. So I've got a thread going that I've been chatting to it and talking about some of these changes that is being made. And I just quickly did a search. I wanted to do a quick fire question, Ben. What do you think the total, it's in the billions, I'll give you that. But what do you think the total revenue is that the government takes on business rates in the UK compared to just retail corporation tax?
I reckon 6 billion in business rates.
Not a bad guess, yeah.
And 2 billion in corp tax.
No, so that one's a bit off, but they take about 25 billion in business rates for all commercial income, and they take 82 billion in corporation tax just of retail spaces. So if you look at that delta, like I'm sure you would rake in more corporation tax.
Yeah,
and people, the UK would be a happier place if you had really cool, quirky. Because when I've realised when the Americans come over, and you're walking past just like empty shop after empty shop, they're like, there's no soul to the to the towns and cities that we live in. And I just think it's the bedrock of everything. Promote supporting local and small businesses and employment and culture, and I think it's just so fundamental, and I just think they need to sort it out.
Yeah, there you go. Well, 26th of November 2025 budget. Let's see what happens. I think everyone's waiting with bated breath on that. So we'll see what comes of it. Cool. On to point number 2, which is our Maple Rise Investor Day. I know some of you that will be probably tuning in now, have inquired about this. We have a good level of numbers. We are close to being oversubscribed. But if you are a property investor looking to deploy some capital into UK real estate over the next couple of years, we'd love you to come along. If you're based in London, this project is in Muswell Hill. It's on the 28th of October, which is a Tuesday. Come along at about 10:30 in the end, 10 o'clock, and see how we deliver schemes like this, see how we operate. We are constantly looking for more funding and joint venture partners to work with to help the growth of our business, whilst also getting a fantastic return to those investors that work with us. So links in the description. click the link. You'll get through to a Google form where you can fill out your details and ask a couple of qualifying questions. We'll be in touch if you are successful making it on the list for the Investor Day next week, or the week after, sorry. Cool. Block valuations and refinances. So if you tuned in a couple of weeks ago, you'd have got the lowdown of our doctor's surgery conversion, which we've converted into 5 flats. We're letting it out as sort of effectively 14-bed HMO or sort of cluster flats. So tune in to, we did a deep dive on this deal. I don't have the exact episode reference, but maybe I'll find it in the background whilst Jack's talking about it. But you can understand how we bought this, what we bought it for, what we've done to it, what the GDV is, what the build costs were, what the finance costs were, everything. We go deep on these details in terms of how we found it, how we structured it, how we financed it, how we built it, and you'll learn a lot from these deep dives. I think there's probably 4 or 5 deep dives within the last 3 years of Property Experts podcasts, and I'd say if you're getting into development, those deep dives are definitely the place you want to be, because you get to see the inner minds of how we operate, how we work, how we structure things, and all the nitty-gritty detail around some of our developments that we've worked on. But this is about block valuations and refinancing. This project is now completed and we are actively tenanting it, which we'll find out more about later on. But Jack's going to run through some nuances around valuations when it comes to kind of blocks of flats like this.
Yeah, it's actually season 2, episode 35 that we did. Nice. The deep dive on this property. I don't need too much time to go through on this. It was actually spurred on because the event we're at, the lawyers that are doing the refinance basically asked why we're splitting up the flats. So essentially we carried out a valuation on site, and I'll be talking later actually in the sort of lettings section about this cluster flat development, about how we're getting on with the lettings and how that compares with valuations. But essentially, we agreed a GDV for the site. No one in the brokerage side of things that was arranging the finance, or even the financiers, or even the valuers, up until the point we got this final report, said that they'll be applying a 15% discount on the whole building because it is a block of flats. Now, I don't know about you guys, but when I think of a block of flats, I kind of feel like 10 plus is really a block of flats. I know that 8 units are a block of flats, but I would call that more like a smaller, more consumable asset type that would be share of freehold sales, doesn't necessarily fall into this massive category of management companies, service charge, and all of that nonsense. It's just a small scheme, and it's almost crazy that if you had a two unit house, that to me isn't a block of flats, but that would be valued at full market value. But then as soon as you maybe go into 3, 4, or 5, it is. So certainly something to look out for. So top tip number 1 is make sure that you check their valuation method. We actually did check their valuation method before we started this, but we actually asked if they'd be valuing on bricks and mortar or commercial valuation, and roughly what they thought there'd be. And they did declare rough valuations, but they didn't disclose that they'll be applying a 15% discount. Now, 15% discount is kind of broken up in their minds between, right, we've got this, obviously a lender is looking at, I always say that it's easy getting money out the door, but it's much more difficult getting it back in. So in the scenario, the bank's trying to get the money back in, and they take control of the asset, assuming Ben and I are crooks, but obviously that's not the case. But let's assume they repossess the building and they need to realize their capital. To do that, the whole point of a gross development valuation or an existing valuation is the value that they're pegging their value to. So as a 70 or 75% mortgage, they need to basically sell this site and recover that capital ideally. And, by all means, they would have to do that. But there's already a 30% buffer between their debt and the value, right? So that buffer is typically selling it, or any equity or any second charge that might be left on the asset. This particular asset doesn't have any sort of second charge. It's basically just profit. So that's at our loss if this property does get repossessed. But what they're actually looking at here with a 15% discount is they're looking at if they had to take control of the asset and sell it, what would happen? So they would have agents fees, they would have legal fees, they would have administration fees, and they're tagging a 15% on GDV costs to do that, which is absolutely absurd. One of their explanations for this is they've actually said because they would have to split the titles on the building, which is absolutely nonsense. To think that it would cost, so this asset's worth about 1.25 million. So to think it's going to cost like, I mean, what is 15% on that? Like 45, 50 grand from a legal perspective to split titles is absolutely absurd. The whole point of loan to value is typically in a situation where they need to get rid of the asset, they'll probably get rid of it quite quickly, maybe auction it. And there is a compression on the value, and they do often sell at a lower value than the loan to value. But additional to this, the 15% is ridiculous. So what they're actually doing is they're lending a 70% loan to value on an asset. They've obviously got 30% headroom already, and they're applying a 15% discount on that. So their technical leverage would at that point be 55%. And we're not getting 55% leverage rates. So, I mean, I kind of don't mind if we have something low geared, but I want the benefit of paying lower cost of capital to be at that level and be, call a spade a spade. So essentially, the reason our lawyer was asking about splitting up this morning is because a way to get around this is we just went back to the lender and the valuer and we said, can we value them all on their own merits, all of the flats, and we would split the titles. We don't necessarily need, that's not a lot of aggravation to get that additional real valuation so that the lender can get comfort. And they basically turned around and said, fine, throw a load more fees at us. We're going to split out the valuations. We might need to visit site again, classic stuff. Consultants getting a bit carried away. But we essentially re-agreed that we're going to value the building where it is without a discount. We're going to split them up individually and split the titles. So that will be 5 different applications on 5 flats. But it means we get the valuation we need. So that was kind of like our way around it. But I suppose you can probably try and nip that in the bud a lot sooner. These are the things that you learn. So just be careful what they're trying to do, and also challenge it, because this was our second valuation. The first came in at £1 million. This one came in at 1.0575 without the discount. It's 1.265. If we didn't challenge that, we might have just gone with this valuation, which is leaving a lot of capital or equity or even cost of capital in the deal if we wouldn't have challenged it and found a creative way around it. So definitely challenge things. And when our broker sent us the valuation document, the brokerage is a reputable brokerage. It's run by a reputable guy, but his team don't necessarily know to challenge everything. So when they sent this through, they kind of said, here you go, here's the valuation. Should we proceed to get the offers? And I was like, no, hang on a second. This is absurd. So make sure you're leaning on those consultants to be on board to challenge, because you're their client and they should be representing you and been getting you the best deals. So make sure you do throw your weight around.
Yeah, nice. I mean, they also tried to say that, we need to send the surveyor back out to site, which we were like, well, this is ridiculous. He's been to site. He's written the valuation. All we're doing is chopping up the individual flats based on the valuations that he's already given for those flats. Why the hell does he need to visit site again? And after a couple of days of back and forth, they came back and said, oh, actually, yeah, fine. It's we can do it remotely. I'm like, well, of course you can. Like, why have we wasted 3 or 4 days having this conversation when it's completely obvious that that's the case? But yeah, definitely challenge banks, challenge surveyors, challenge everything. I think we've said that numerous times in this podcast. Challenge everything. Cool. So St Andrew's Court in Tame. This is phase 2. It's flying ahead, which is great to see. Scaffolding's up now to start all of the roof works. For those that haven't seen this before, this is what was a 17,000 square foot office space, chopped into various office units. We've shifted some of the commercial tenants down to this end of the building. So we have 2 commercial tenants sitting in this roadside. We've converted the middle section of the building to 9 flats, which was phase 1, and we've got 8 of those 9 either sold or exchanged or under offer. We've just got 1 flat to sell remaining in that block of 9, and then we've got this end chunk of the building which we will be converting into 11 flats. But in order to just to complicate things even more, just to get 2 of the phase 1 units sold, it utilizes the same stair core as phase 2. So phase 2A, if it is what we've sort of dubbed it, is actually getting the stair core completely finished so that there is a safe means of escape from flats 11 and flat 16, which form part of phase 1. And that's what you see on the right hand side. So as of yesterday, the building control officer came round to sort of sign off that communal area. We've got the carpets going down on Monday. Part of this is making sure that All of the utilities were put in and planned for ASAP. The corridor was fire lined, fireproofed, fire masticed. All of the services that penetrated through that 60-minute fire compartment were masticed and fire collared and everything that needs to be done from a fire safety perspective. Now, even though there is works happening literally the other side of that party wall, so basically this on this right hand side, left hand side of the wall here, beyond that is a construction site. So ultimately, all the way along this is a 60-minute fire compartment. We've segregated that part of the stairs so that means of escape can be granted for flats 11 and flat 16, whilst all of the rest of the office space is being converted into 11 flats. And even those 11 flats are flying up. We've got all of the utilities in. We made sure that we had all of the trenches dug and utilities installed before scaffolding went up. So quite a good a bit of logistics and a programming kind of thing that we've made sure we've done to make sure that we don't have to have any delays with utilities whilst the scaffolding is up and the roof's being completed and all that sort of stuff. So yeah, it's really coming along now. The floor for the loft level is in, which gives them a solid base to start taking the roof off, which means we'll then start seeing the dormers go on, the tiling going on, the flat roofs going on. And yeah, we'll start to see this completely transformed now before Christmas. And by Christmas, we should have all those dormers in, the inset balconies created, formed, and that roof should be watertight, ready to then fully go hell for leather on the internal fit out, which I'm looking forward to. This one will be completed by May. So May next year, we will have the full 11 units completed. We'll start selling in January and start launching more fully, and we'll make sure that we'll get one of these units completed probably within March as a show flat, ready to start showing people around, showing them the quality of finish that we are going for, and hopefully we can then secure some off-plan sales for those 11 units. So yeah, really happy with this project so far and how the second phase is going. It's the same builder that's gone from phase 1 to phase 2, and they might be tuning into this, so hello. Stay tuned to find out how this one progresses. Speaking of tame, what values of the commercial market are moving right now? Not ours.
Yeah, so I was actually talking about this on the ground up the other day, and I thought our audience would love to hear this as well. And coincidentally, while I was putting this slide together, there was a discussion in our WhatsApp group with one of our investors about our commercial site in that as well. So essentially, we're if you speak to a commercial agent, it's a super difficult market. The commercial market is very cyclical. Or volatile to the economy or the economic confidence, and also the cost of borrowing money, and also inflation and various things like that. So essentially, the reason that I wanted to bring this slide is because typically there's certain areas of the commercial market that move better than others. And we found even in our social housing portfolio and the asset that's on the right here, if you can see the screen, it's over £1 million, and it's an income play, really good tenant structure, I think, really good leases in place. I mean, one of our tenants, Ben, I don't know if you know this, turns over about 22 million quid in turnover. So a really strong tenant and lease, which is on a 15-year lease. And it's 1.2 million quid, and we haven't had zero sniffs at it, zero interest on the open market. And that just goes to show that the larger assets, the bigger size assets in this market are struggling to move around. And I'm not only getting that from the source that actually listed both of these properties that's Henley based. We're buying an asset at the moment through Allsops, and they basically said, yeah, that anything above 500k is really difficult to move. It's just people need leverage to buy those assets. They're not really moving. I think then as soon as you get to a massive size, so much larger assets, maybe 10 mil plus, that market's probably doing okay because it's a buyer's market. They might have the cost of capital locked in for 5, 10, 15 years, and they might still be transacting okay. But it's this kind of like what I would call sort of like small, obviously they're quite large assets because they're over 500 grand, but that smaller middle layer market is just not moving. It's just a tough market to be in. To sell, buying's fine because we can convert them to resi, which is great because it's providing more housing and repurposing those buildings that are sticky and probably not really an asset, more of a liability at the moment on the books. But that sort of middle segment is just not moving. Now, in the contrary, small little acquisitions, so sub 500k, we're still seeing moving. So we've sold two small retail units in Wallingford, which is in Oxfordshire, really easily, really quickly, at fairly good values, like 9%. For a dirty little, retail unit in a small town that's not massively that popular, maybe with a good tenant, bad tenant, doesn't really matter. We're selling those at good values. And I think that's really important to acknowledge, that there may be gaps in the market where you could either capitalize on it being difficult to shift the bigger assets and repurposing them, or even capitalize on what we're doing, which is buying shops and uppers, trading the shop out and selling that. But the reason we actually do that is because a mixed use mortgage is like 7.5%, and just a straight residential mortgage, which is you can get for the uppers, is about 4.5-5% at the moment. So the cost of capital is a lot more beneficial for net income. So there's some things to think about for acquisitions, and there's also things to think about if you're carrying these assets in your portfolio, what you should potentially do. And if it is a let sort of 500k, million, 2 million, 3 million pound asset, maybe just sit on it for the time being, because the market will get better. And you kill yourself if you put something on the market at £1 million, didn't get any bids, took 800 for it, and then a year and a half later someone else sold it on for 1.5 million quid, you'd be really kicking yourself and being like, oh god. And that is how cyclical the commercial market could be. It's very volatile to cost of finance, inflation, cost of labor, the economy, local economy. So yeah, just something to be considerate of.
Nice. I think Jack also let out a massive secret in that conversation, in that we did a deep dive last week on commercial conversions and how you can use Class MA, Class G permitted development rights to convert office space and retail space and Class E use buildings. And at the moment, they're going for silly money in terms of cheapness. You're picking them up for let's say 9-10% yield day one. Some opportunities for even greater than that in terms of day one net yield. So not only are you getting a cheap price for a lot of building, you could potentially be getting a decent yield day one with the future potential development opportunity to convert to resi and sort of supercharge that return. So there's lots of really good deals out there at the moment. We are certainly looking for, as we mentioned at the start of the podcast, for people that have a bit of cash and really want to take this opportunity over the next couple of years to find decent deals, really good solid deals out there at the moment, where people people's expectations of value are being more aligned to where the market is, and the market is very, very low. So if you've got some cash sitting around, if you want to invest in commercial property like this, that you want to work with developers like us to convert into residential and get great sort of equity and sort of profit returns off the back of it, with a potential for rental income over the next 5 years as things sort of go like this through the roof with the rental side of stuff as well, then reach out, because we'd love to have a chat with you. But yeah, certainly an opportunity right now to snap up some good deals. Speaking of good deals, some really good news came through this morning. Actually, we haven't let our investor know actually on this yet, but I'll message him straight after this. But we had planning approval through for the airspace development at the back of this site. And again, we did a deep dive on this back in season 3, number 18, episode 18, about buying a bank and what we're going to be doing with it. This was an old Halifax that we're converting the ground floor and basements. Sorry, we're selling the basement and ground floor space to a retailer. We've converted, or partially converted so far, halfway through it, converted the upper levels into 3-bed HMOs, and the successful planning approval and listed building consent yesterday came through for this rear section of the building, which we will be converting into 4 flats. So we've got a first floor level which is existing. We secured a fallback position on this first floor using Class G permitted development, which allows you to convert space above a retail use Class E building into C3 use up to 2 flats. So we secured the fallback position to get 2 flats at least. And then we've gone in for full planning to extend an extra floor and get an extra 1-bedroom unit up in that airspace. And then also fill in a car parking undercroft that is effectively plant room, boiler room, parking spaces, almost dead space, and creating a 50 square meter one bed on the ground floor in that undercroft. So 2 additional units, taking it from 2 to 4 units. I think all in all, that GDV of the rear is something like £1.3 million. And we will now be starting the technical detailed design to push that forward. We're refinancing the whole site, carving off the retail space that we're selling, carving off the HMOs, which will be finished by the time we refinance into the 3 HMOs. And then we'll get left with a development facility to the rear to deliver these 4 units once those HMOs are completed as well. So nice phase scheme, get some money straight back in through the door as soon as that retail unit is done. By Christmas time, we'll have those HMOs ready and available. That's 9 extra rental units that should achieve something like probably £850 to £900 per room. And then we've got the airspace development to the rear, which should generate, probably 200 grand's worth of profit for us. So yeah, great deal. And we'll keep you updated as things progress. But if you want to learn all about that deal and how you can find this type of thing, fund it, structure it, design it, head over to season 3, episode 18, where we do a deal deep dive fully into the full project, including every single penny that we're going to spend and how it all breaks down. Cool. Onto something a bit more for everyone that wants to run a business. You need to, if you want to be successful in business, you need sales, you need leads, you need inquiries coming through the door, and you need to know how to convert those inquiries. But in order to get leads through the door digitally, you're going to want to understand the digital marketplace and how you can generate leads in the digital real estate world nowadays. That's using things like Google Ads, Meta, so pay-per-click advertising on Facebook, on Instagram, utilizing LinkedIn ads, although they're still very expensive, albeit you've generally got quite a targeted audience on LinkedIn where it's a professional audience. So for something like XP Surveys, where we are predominantly a B2B operator, i.e. business to business, we want to work with architects, we want to work with interior designers, landscape designers, and things like that. LinkedIn being the professional outfit that it is, and the professional kind of platform that it is a great place to advertise. And then also from a digital perspective, it's a very slow process to build your website up in terms of SEO, which is search engine optimization. So you need to start as soon as you can when you're starting a new business, because ultimately it takes time, and you want to build that kind of evergreen blog content, technical SEO content through the website. I think we've done some sort of bigger deep dives on this, but ultimately SEO is how well you rank on Google. When somebody's searching for you, do you rank on the first page? And if you don't rank on the first page, I'm not sure I know many people that get to page 2, let alone page 3 or 4 on Google, before already clicking on somebody's name and progressing through to their website, and they're the winners. So SEO is fundamental, but it takes time to build that, and for Google to recognize your website as the champion for the topic that you're talking about. The newest thing in town is GEO, which is generative engine optimization. And with that, and the definition here is GEO is the practice of optimizing content so that AI-driven platforms like chatbots and AI overviews can understand, trust, and cite it. So when you're now typing things into ChatGPT, typing stuff into Google, and you have Gemini come up with a automatic response for you, basically answering your question there and then, what it's done is scanned the whole internet, found trusted sources where it can cite the answer to your question. And it will use that information in the response. And what it would do if it picks you as the source of trusted information is cite you as a reference for that data and that information. So obviously, when you search that on Google now, or you type in ChatGPT, and it tells you where it's referenced the information from, you can then click those references to go more into the detail of the answer of the questions that you've asked. And obviously nowadays, GEO is effectively the new SEO. So you want to be having your website in a place where it is the trusted source for the questions that you ask ChatGPT and Gemini and whatever other chatbot or AI platform that you use to ask questions now. And I'm sort of really happy to see that we are actually now getting a couple of inquiries a week, or a month into Aura for a London-based cost blog that I created probably about 5 years ago. So it ranks really well from an SEO perspective, and because of that, ChatGPT picks it up and cites it when you ask something like, what are the likely build costs for a home extension in London, for example. We're often now cited in ChatGPT with Aura Architecture for a blog that we wrote, and it sort of takes a lot of the case studies and information that that was written in our blog and updated every year over the last 5 years. So GEO is really where you want to be. And that's the reason we have brought digital marketing now in-house. So we have used a agency for the last probably 5 years in Aura and probably for the last 3 years in XP Surveys. But we were getting to a point where we were spending the best part of $3,000 a month between those two businesses on mainly SEO and a little bit of PPC campaigns. Now, for that $3,000, for example, the agency rate might be £60 an hour. So we're spending $3,000. We're getting £60 an hour worth of time. We're getting 50 hours a month for across XP Surveys and Aura from that agency. Now, at $3,000 a month, we can probably hire someone plus national insurance plus pension for the best part, probably 40 grand. We'll get a good level of experienced digital marketing person, and that's exactly what we've done. We've got a guy called Marcin coming in. He's going to be doing 2 days a week within Aura and 3 days a week within XP Surveys, and he's going to be doing 40 hours a week. So he's basically going to be doing the best part of 160 hours a month for us when we were previously getting 50. So we're getting 3 times the output for pretty much the same financial outlay, and that for me is a very good return on investment on bringing that person in full time. So when you're in business, these are the things you should be looking at. Can you supercharge the return on investment that you're making? Having an external resource and external agency is great if you want fluidity, if you only want month by month rolling contract. You don't want the overhead of having somebody on the books and PAYE and stuff like that. But ultimately, there's also a lot of people out there that don't necessarily want to be on the books. And they might also want to be a full-time consultant effectively for you and do some other bits and bobs along the side. But you're still getting that level of expertise, still getting that level of dedication to those businesses in terms of time spent within those businesses. And that's exactly what we're going to get from Marcin. So he's going to come in, very experienced background, ready to jump into a new challenge. And I think for him, having two businesses to get stuck into was a massive bonus for him, so that he can have a little bit of variety and get stuck into, for Aura, initially PPC campaigns. So we've got a really good solid foundation from an SEO and technical perspective within Aura, and really we want to start now driving and pulling in traffic to Aura by utilizing Meta advertising on Instagram and Facebook, Google ad campaigns and things like that. And then with XP Surveys, we've still got a lot of work to do to get our SEO, our GEO and our website looking as good as it can be, so that when we do start spending the money on PPC, we haven't got a leaky bucket on our website where the website isn't as good as it can be. And ultimately we're driving loads of traffic to the website, but the website is a leaky bucket and it's not converting as well as it can be. So we've got to get that website up to scratch first and then drive the traffic to it to hopefully convert more leads. And that's how we're going to scale XP Surveys nationwide over the next couple of years. So that's why we're bringing a digital marketing person in-house, and hopefully that's useful for a couple of people out there.
Lots of leaky buckets today.
Yes. The government is the biggest one.
Yes.
The trick of offering.
Yeah, just to touch on sort of acquisitions and talk about what we're doing. So we've got, and I was actually talking about this today. So we've got a couple of bids out on a few sites. This is actually more speaking about central suites. And often in a bidding process, you sort of do a lot of work and you play around with a deal and you tweak it and you find a bit more value and you find a bit more cost and you go, oh shit, we've got to think about that. And then you're playing around with it and it's constantly this moving target. And then you get to a point where you go, what am I comfortable with in terms of risk, and push the value up or and sitting at. And that's typically around the point of bidding, because you typically get a bid forward and then the seller might come back and go, well, if you can get to here, then we'll do a deal. And then you have to analyze whether you want to take that risk. And there's been a lot of that recently that I just don't think. So I constantly in an acquisitions mindset, think about what are their other options. And if you're in a really driven market and you're not pushing yourself to take that risk, someone else is probably going to buy it, and you've got a lot of competition because there's confidence in the market space. But acknowledging that there isn't confidence in the market space at the moment and people aren't doing a lot of things, don't be afraid to stand your ground even more. We're massive advocates for getting to a price and sticking to it. Sometimes we might incrementally nudge a bit more on if we really love the scheme. But that's not really going to be the straw that breaks the camel back, that sort of smaller uptake in bid. But what I'm saying is be more rigid than before in a positive market, to just go, actually, we're happy for you to keep doing viewings, keep trying to sell it to someone else to see how you get on, because you're either going to become more distressed and we're going to get it at the value that we want, or you're going to sell it, and you have to be patient in this market. And I think that's really important, because the last thing you want to be doing is taking an element of risk in the market getting worse, because it's already not that positive. So I don't think you want to be taking extended risk in those markets. So just be wary of patience, understanding, what one of the bids that we offered on, to give you a bit of an idea, it's the guide price was 425, I think. We've gone in at 300, and it's been on the market for a year. And I'm kind of happy to let that roll into the new year, because if it's been on the market for a year, I can't really see it selling in the next 3 or 4 months. So basically that's the view. So understanding that, I was just like, you just need to be a bit more patient, and that's kind of the ethos of this.
Nice. I've just actually seen that our investor for the bank has joined the live video on Instagram, so he will find out about the successful planning approval that way without me WhatsApping him, even though I will anyway. Cool. Just a quick update on the doctor's surgery conversion that we talked about just a minute ago. We finished that a while ago, like I said, and we've had it on the lettings market for what now? Probably only about 2 weeks. But we are smashing the lettings ceiling that we anticipated. Jack, you know more about what's going on with that than I do. So
yes, there's a couple of things to touch on here, really. Took us forever to get this thing to point of letting because of building control delays and various things that we were waiting on. But we finally got there and got the building control sign off and got the marketing out. One learning that we actually felt from this one is we essentially, in theory, think it's best to launch on spare room. These are cluster HMOs, so it's 5 flats, 4 of which are 3-bed HMOs, and we let them out per room. So we think typically it's best to launch the spare room once you're ready, once you're literally ready for someone to walk in. But then also you're missing out on the market of people that are viewing before you actually launch that ad. So it's a really difficult decision to make of when do you launch. And we did launch this a bit early because we thought we would be getting the approvals a lot sooner, but we didn't. So essentially, the reason I wanted to share this is we've now had successes. We've let 9 of the 14 rooms. We're now on target to hit £131,000 per year as a gross revenue. Our targets originally were 121,000 per year, so we've actually smashed our targets, which is testament to design, construction, lettings team, all of the teams that have worked in that to get those results, which is great. But also I wanted to touch on, so yeah, I suppose positive news. We're well underway of getting the thing let, which is amazing, and will help those valuations. But the other thing I wanted to touch on is we've had 2 valuations on this site, one from Vail Williams and one from Allied, and the 2 valuations that they have put in their Red Book valuation. So this is not what they thought it would let. This is not what. This is what they think it's going to let for. But the proven evidence is we're at 120. They're at so Vail Williams were at 82,800 per year, and Allied were at £87,000 per year. So our estimations were £40,000 more. Are actually likely achieved is going to be £50,000 more, which is a huge discrepancy. And I wanted to share that just to show that a valuation isn't everything. A valuation should be a fair testament on the market. And this evidently isn't. It's people just being scared. And you can see that their actual red book total valuation, Vale was £1 million, and then we weren't happy with that, so we went with Allied, who were 1.275. We're actually still not really happy with that, if I'm honest, but it's enough to get the deal done and get it refinanced, which is more important now. But it just goes to show that actually what you achieve can be so far removed from what valuers. And the funny thing is, I would be amazed if they still come back at 87,000, because we've sent them these letted units. So now they've got proven evidence of ASTs in place. And we actually have our first tenant moving in Monday to show that that is the market value.
Nice. I mean, just based on that, yeah, you know, it's a 10.3% yield on what they valued it at. So 131 grand divided by the 1.275 million that they've valued it as, yeah, just over a 10% yield that we'll be achieving on that valuation. So, you know, if they were to actually value it on an investment yield of, you know, even 8%, you know, they should be adding a couple of $100,000 onto that valuation. But we've only been able to achieve this because we are letting out, you know, rooms individually. We're running those small kind of 3-bedroom HMO kind of cluster flat type model, which is a way of, you know, a great way of sort of supercharging your rental income. The negatives of doing that is that obviously as a single let, it would be onto the owner to pay council tax and bills and all stuff like that. We're taking that responsibility as the as the HMO investor landlord. But in terms of the gross rent that comes in based on letting them individually as opposed to a individual single let, you know, it's still well worth setting it up in this way and taking the burden of the utilities, etc. Because it's more profitable for us. Cool. So there's a couple of questions that came in from last week, which sorry, it might have been the week before, but we're just catching up. But Jimmy, thanks as always for kind of tuning in. Once you have planning granted under Class MA, why don't you apply straight away for full planning to add your flats rather than doing it in 2 stages? Once you have planning granted under Class MA, why don't you apply straight away for full planning to add your flats rather than doing it in 2 stages? I mean, I guess the sort of way of utilizing Class MA from day one as your first phase de-risks the project for you. It secures your approval, which might unlock your bridging finance or your development finance, sorry. And ultimately, you've got an approval that is a residential change of use, which when you then go back in for full planning, that's just one less box to tick because you've already sort of established the change of use into residential via the Class MA process. And full planning just takes a lot longer. So for speed, getting a Class MA application and having it discharged within 56 days. And if you tune into last week's or the commercial conversion deep dive, you'll sort of understand more about that. You'll understand that what the benefits are of going Class MA first to establish that change of use, and then going in for the more rigorous, shitloads of planning, shitloads of additional supporting documentation and assessments, a much stricter process and things that they'll be looking at from a full planning perspective, and a much longer time frame to get that through full planning. So that's why we sort of do one first to secure it, secure the change of use, and then go back in for the full planning to optimize it. Have you ever obtained a certificate of lawfulness to confirm that a flat granted under Class G can be converted into a C4 HMO? So under Class G, there is no requirement to, there is no removal of your PD right to go from C3 to C4. So there's no reason under Class G you can't just go straight in for a HMO. Would I ever go for
it's a 7-bed?
Unless it's a 7-bed HMO, because then it would be sui generis. Have you ever obtained a certificate of lawfulness to confirm that a flat granted under Class G can be converted into a C4 HMO? I mean, no, we don't tend. I mean, we have done in the past. I guess very not very often would we actually get a certificate of lawfulness for a small HMO. That C3 to C4 use kind of permitted development is interchangeable. So ultimately, you don't really have to get an approval of any kind to do that. You get some solicitors that want a decision notice or something to satisfy them, but most of the time, if we've been asked for that, we just push back and say it's not a requirement. It can be done under permitted development. We don't need any approval from the council to do that. So I'll generally just push back on that. I think we've got time for just one more question from Fiseo. Thanks very much for your comment. How do you handle buildings elected for tax? Have you always been able to claim the purchase VAT back, and how do you structure this? We do things slightly differently, and there are VAT bridging specialists that you can go to pay for the VAT, to bridge the VAT cost between purchasing the commercial property and potentially getting the reclaim back, and that they'll bridge that amount, but it's quite expensive. And also, when you do pay for buy a commercial property with VAT on top of it, you also pay stamp duty on the VAT amount as well. So what you should be looking to do is try to de-opt the property for tax before you buy it. So we generally work with the buyer, work with the seller to, is it a 1614D form?
Yeah, so the form, which is on the government website, I can actually send a link to it in the comments, is a VAT 1614D form, which is a form to disapply the option to tax buildings, but it only works for conversions into dwellings. So it doesn't work for new build land, or, I mean, not that land is typically elected, but that's an example.
Yeah. So typically, for SEO, I would be looking to de-opt before buying it. So you're not then having to actually deal with any VAT, pay any VAT, or reclaim any VAT because you're not paid it in the first place. Cool. Hope you found that useful. We are here as always every Friday at 4:30. Please do drop a like down below, and if you're not subscribed, please subscribe. And if we could ask you to do just one thing that will help us massively to share this with as many people as possible, is to drop it into a WhatsApp group that you're part of. Tell them how amazing it is and how much value you get from these Friday sessions. We do this for free. It's a good opportunity for you for free to ask award-winning developers and business owners any questions that you have within your business that you're struggling with. So get them in, and we look forward to seeing you next week. Cheers. Bye.
Bye.
Bye.